Hi, I'm Peter Rose, founder of Longwood Currency Trading, and I wanted to discuss with you the difference between a 50% retracement event in the currency forex market as opposed to a fib, 50%. If you've listened to my channel at all in the past, then you know I've got a bachelor's in physics and almost a minor in math, so I've got some awareness of statistics, probability, and how the world works. And you've heard me discount Fibonacci analysis. There is no connection between a 68 point whatever it is value in a fib and where the price happens to end up. There's no correlation. If I paint if my car is blue, somebody had to paint it. There has to be a cause and an effect to everything. Why does a price cause a fib to happen, or why does a fib cause a price to happen? There's no correlation at all. You can use a Fibonacci in analyzing tree rings or the population growth of certain species because there's a correlation between that, either from a biological or agricultural, whatever sense, but not in trading. So why would I say that the 50% rule, retracement, it's not a rule, the 50% retracement event is valid? Isn't that a fib? Yes, there is a fib 50%, but it's not a retracement level, a retracement point. The reason that the 50% retracement rule or event is valid is because currency trading is a zero-sum game. If one person wins, the other person loses. That's just the nature of the game. Now you could say, oh, well, I sold, the other person bought, and price continued to go up. So if I sold, I didn't lose on the gain. I gained on whatever I made since where I bought it, and I'm just selling to profit. Yes, but you're still losing on the benefit that the guy who bought made. It is a zero-sum game. There's no stock certificate that you can lend against. There's no money that you can put in your bank that the bank is going to lend out 10 to 1 or 9 to 1 or whatever it is. There's no, there's nothing like that. You either win or you lose. And so what happens when price goes up and there's an exchange at that point? Somebody who sold short is going up, I'm not going to take any more of this heat, I'm going to get out. The guy that bought is saying, I think the price is going to continue to go up. And in fact, if it does, then the person who got out did lose on that value. But the point is that a currency pair only exists when there's a buyer and a seller. So that means that one of those people is wrong and one of them is right. If you have 10 people and they all make a trade, 5 of them are going to be wrong and 5 of them are going to be right. And so if 5 of them are going to be wrong, then that's going to stop the price action when enough of the people go, oh my God, I've been short this thing and the price just keeps going and going and going, and I can't take any more of this and I'm going to get out. Now where do they all get out? 10 pip trailing stop, 15 pip, 20 pip trailing stop. It's Tuesday, and so you get out at 1.2486. I don't know what it is, but because you're dealing a lot with psychology and the herd, and people are looking at price structures and all that sort of thing, there is a probabilistic likelihood that more people will exit the trade at a certain point. And so therefore, when you have an event like that occur, you're going to get 50% of them wrong. So the price will go, if you're doing a retracement, will go 50% of whatever the last value, the last distance was, because 50% of the traders can't take the heat anymore and they get out. And so price will retract 50% from where it was. If it came down, then you're going to come back up and retrace 50% of that down move, simply because it was such a radical move and people set their stops, and so it's going to drag the price up to there. You have to understand that in order to make a determination as, is this a retracement that is then going to turn around and continue in the original direction, or have you reached an inflection point? Have you reached a swing point where the price really has turned around? What would turn it around? Everybody gave up on that short stuff. This thing is just not going to go down. It's going to continue to go up. I'm going to get out. And as they continue to get out and sell, the people that are buying, and so that price continues to move up until it gets to a point where there are far, far more buyers than there are people selling, and you don't have this stabilization of price, and price will continue to rise. Can you determine that ahead of time? No, you can't. You can determine it in real time by your experience with that currency pair, the time of day that you're trading, how long the overlap between the two pair countries, business hours are. What's that based on, though? It's going to be based on the momentum of price action. How much is that candle moving? What's the conviction that things are turning around? If you have a violent candle reaction, everybody went for the exit doors. And so you have to look at that and say, have all the weak players been flushed out, and now the big institutional traders are going to continue with price action because they bought their stuff on sale, or what? How is that affecting it? Could it affect it? Is it coming up to the weekend and people are not confident in their positions, and so they're just all closing out? Is it London Open? That was the big technique quite a while ago, where you'd look at the London Open, you'd take a look at what happened in the first hour, and that was going to be the main direction. You get a lot of chop, but the trend was set at, I don't know what it was, first hour, first 15 minutes, or whatever the hell it was. And so everybody would jump on board and get 10 pips, and you could do that. However, the market since then has changed dramatically. Not that the market has changed, but the number of participants and the dollars have changed. That rule was valid when maybe the size of the currency market was $4 trillion a day. Today it's almost $7 trillion. And back then, when it was 4 trillion, 15% of the market was retail traders. I don't think you can go from 4 trillion to 7 trillion and say that 15% of the $7 trillion market is the retail market. I don't think there's enough retail money out there to compete with the larger institutions. And so the larger institutions aren't falling prey for that shit. They've got work to do. They can't screw around with retail traders. And so it was the retail traders that were kind of a self-fulfilling thing. And the institutions were going, wow, we got a lot of retail traders that are falling for this crap, so we'll just take advantage of that. We'll let them run that up, and then we'll all flush them out at the end, the ones that aren't smart enough to get out. And that's why it wasn't a long-term or a position trader or even a swing trader that was going to make money on that. It was going to be a day trader, and they were all only looking to clip 10, 20 pips, and then they were gone. They didn't care what it was going to do after that. remember, the big institutions are the dog in this. The retail traders are only the tail. And as the market gets larger and larger, I suspect, but don't know that for sure, that the percentage of the retail trading volume is getting less and less. It is increasing, but I don't think you can say, oh, when the market was 4 trillion, 15% of 4 trillion, whatever that is, 400 million, 500 million, is going to be retail traders. Because now you're up to 7 trillion. So can you have a trillion or trillion and a half retail traders? I don't think so. And one of the reasons is because the weak players got flushed out. They all went to crypto. Now they got flushed out of crypto. They don't have any more money left, so they're not going to be back in. But there'll be other fools going into the crypto market as opposed to the retail market in currencies, because the guys that are out there touting crypto right now are the same guys that used to tout Forex. And there aren't as many, stupid people that listen to that shit now in Forex. They all went to crypto, so all those guys have moved over to crypto. And there's no basis for the crypto market anyway, except, you're going to sell into somebody who's willing to buy it from you for more than you paid for it. I mean, that's the only thing that it's based on. It's not based on anything. The weather determines the price of wheat, or interest rate deviations change the currency markets, or a pandemic hits and that changes everything. It's just, can I find some dumbass to buy this for more than I paid for it? At some point, everybody says, I don't want to buy it anymore. I don't have any more money. And so if there's no buyers, the only thing you can do is sell. And that's what causes these large movements in the crypto market, because it's not based on anything. It's just paper thin. So as those folks move out of the currency markets, it reduces the number of players in the retail section of that currency market. It's a more educated group. Unfortunately, the education that's still being provided to them is not it's not valid, because it's based on indicators and fibs and all this wild crap that just doesn't have any basis. There are some good points of that. For example, the 50% retracement event is a real thing. That happens real. Why is it real? It's because of the exchange. Based on the economic conditions that people are viewing that market, which is two-pair countries, as to what the differential is between the economies of those two-pair countries. So there's real order flow going on that's driven by large institutions primarily, and not the retail group, which is a great thing, because you can understand what the institutional traders are trying to do. They're trying to conduct international commerce. It's like a great big ocean liner. It's not like a little motorboat. You take a motorboat, turn directions in a second. I got an institutional trader out there. He's trying to do a $3 billion currency order. He's not going to dump that on the table in 2 days. It's going to take him some time to get that out. And the way that he does that is predictable. And that's what causes the retracements in the price action. And the reaction to that, many times, are the retail traders doing the small retracements and things, because they're just getting in and out on whims and bad education, and, oh yeah, it hit a 68 fib, I'm out, or I'm in, or whatever stupid thing they're doing. But the institutional trader isn't encumbered by any of that. They're looking at the fibs to kind of get a better idea of what the retail trader is doing. So if you're using those indicators, you're being watched, and you're being hunted, and you're being taken advantage of. Not that it's a bad thing. The institutional trader is looking for liquidity. So we can provide liquidity and move in the correct direction with them, or you can try to think that you know more than they do, and you can use these fibs and all the rest of the stuff, indicators, and the institutional traders just roll over you. So it's more important for us today than it was 10 years ago to pay attention to what the institutional trader is doing and why he's doing it and what the economies of the two pair countries are doing, even if you're a day trader. I'd say at least 10% of your view as a day trader has to be the fundamentals. If you know that non-farm payroll event is coming, you better pay attention to that. If you know that the Fed in the U.S. is going to raise interest rates 80% likelihood by half a basis point next month, you better pay attention to that. If the economy of Germany is getting so much stronger and they're reducing their interest rates and all that, you better pay attention to that. It's not that you have to understand why these things are happening. You just have to look at it and say, this is what potentially could happen. It's like looking at a stoplight as you're approaching an intersection. You can't just go roaring up to the stoplight because that could go orange any minute, or go to red. And so you have to approach the intersection cautiously, even if the light is green, because it could change, or some dumbass could blow his action on his side. That's a fundamental view of driving your car, as opposed to the technicalness of turning the wheel and stepping on the gas and that sort of thing. And so when you're looking at the educational material and information that's out there, you have to be educated enough to understand what's potentially good information as opposed to what's bad information. And in this instance, where we're talking about the 50% retracement event, is a good event that has causes that create that, as opposed to a fib level 50%, which has absolutely no correlation to what the price action is going to do. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.